Good afternoon, esteemed attendees. I extend a warm welcome to each one of you on behalf of Direct Tax Committee of ICI. Today, we are privileged to host a webinar on a very interesting topic of navigating in presumptive income provisions under Section 44 AD and Section 44 ADA. Before we delve into this session, allow me to introduce the leading leaders of this session. Firstly, we have DTC Chairman CA Piyush Chajed. With over 2 decades of experience, CA Piyush Chajed is a seasoned chartered accountant and a senior partner at Mrs. Chajed and Doshi Chartered Accountants. His expertise lies in direct tax and indirect tax appellate proceedings and arbitration proceedings. CA Piyush Chajed is also a respected speaker on various direct tax direct tax topics. He is also a member of external committee of RBI's Assets Reconstruction Committee and a crucial contributor to the WIRC publication on Vivad Se Vishwas scheme. He is deeply involved in litigations in both direct and indirect tax domains. Next, we have the Vice Chairman of Direct Tax Committee, CA Kota Srinivasan. He is a graduate from Bangalore University and is a fellow member of both the Institute of Chartered Accountants of India as well as the Institute of Cost and Work Accountants of India. He is a partner at SSB and Associates, a chartered accountant firm based in Bangalore. With a remarkable service record spanning over 2 decades, Srinivasan sir has held various significant roles within the institute, including serving as a chairman of WIRC of SIRC during 17-18. During his tenure, he has marked several impactful initiatives such as introducing annual regional residential course on international taxation and organizing a regional level interstate cricket tournament for the members. He has also been instrumental in collecting significant contributions towards CABF and conducting numerous CPs program at SIRC. Finally, our distinguished speaker of the day, CA Rajesh Mehta, a fellow chartered accountant with an extensive professional journey dating back to 1996. CA Rajesh Mehta is based in Indore and currently serves as the Secretarial General for the year 23 of the All India Federation of Tax Practitioners. He is widely recognized as a leading expert in direct taxation across India with a deep understanding on various topics including TDS and TCS, capital gains, search and seizures, penalty and prosecutions, HUF, religious and charitable trust, tax audit, union budget, and income computation and disclosure standards. CA Rajesh Mehta is a sought-out speaker at various branches of ICI, Tax Bars Association, AIF, TP, Business and Trade Associations, and various other online platforms. His articles and views on income tax provisions are highly regarded and frequently published in tax newsletters, magazines, and online tax forums. Additionally, he has been honored and recognized at his various academic achievements by the state government of Rajasthan. So we are truly privileged to have such an esteemed speaker with us today, and I am confident that their insight will enrich our understanding on this subject matter. I look forward to the engaging and informational session ahead. I now request CA Piyush Chajed to give his opening remarks.
Thank you very much, Gaurangji, for the introduction of Chairman, Vice Chairman, and also the speaker. Kotaji, Gota Srinivas, my Vice Chairman, has already joined. Faculty for the day, CA Rajeshji Mehta from Indore. DTC team, the Secretary to the DTC, T.S. Subramaniamji is with me. Prachi, I could see on the screen. Rudrakshi is also with me. They have all joined. So friends, a very good afternoon to all the esteemed members of our institute who have joined to listen to a very important speaker, CA Rajeshji Mehta, on a very important topic, basically on the presumptive taxation presumptive income, I would say, 44 AD and 44 ADA. These topics may sound very simpler, but I understand that there are a lot of confusions, lot of issues, and lot of questions are also there. Rajesh ji, I thank you very much for joining us, and I acknowledge your support to Direct Tax Committee. I was a vice chairman last year, and I would acknowledge your support to DTC has always been there, whether it was making of publications, contributing towards those charitable trust technical guides or guidance on tax audit. We recognize that. And you have been always on the forefront whenever DTC has sought your help, either as a speaker or for reviewing the technical publications. Thank you very much, Rajesh ji. Dear members, as you may know, the generally council is for a 3 years period, and every year council committees gets changed. So after 12th of Feb, when it was taken over by the new president of our institute, CA Ranjit Agarwal ji, the committee was reconstituted. And I, who was the vice chairman earlier, became the chairman. I got an opportunity, and I would thank our president, Ranjit Agarwal ji, for appointing as the chairman of this most important committee, Direct Tax Committee. As you all know, predominantly, even today, 80% of our members who are in practice are engaged in direct tax practice. And therefore, it becomes a very important committee from an institute perspective also. I have also joined by my very able friend, council member Kota Srinivasan, who is a vice chairman, who was member of all the standing committees of the institute, and who has contributed to the International Tax Committee also in his first term of the council as a vice chairman. And after last year, when the Direct Tax Committee and International Tax Committee got merged, now it's a one committee. And therefore, it's our pleasure to be amongst you. And it would be our endeavor to take forward the initiatives of the Direct Tax Committee, which I would try to briefly touch upon before we start with the today's technical session. As you may be aware, that Direct Tax Committee plays a very important role. And most important role has been the publication of guidance note on tax audit, which was revised last year itself on 2024. In last 2 months' time, a lot of people, whenever we go to visit to branches or the regional offices, a lot of queries have been raised that whether the institute would be coming up with any publications or any guidelines specifically with reference to Section 43, capital B, subclause H, which is in relation to disallowance for the payments, delayed payments to MSME. Obviously, we were discussing at our committee level also that whether we should come with an handbook, whether with a technical guide or with a guidance note. Because there was a discussion happening that generally our guidance note on tax audit covers those issues which are covered in Form 3CD, which is notified. So that is the notified Form 3CD. And you may look into it that 3CD notified form did not included amendment. That amendment was not made earlier until day before yesterday, wherein subclause H was included. And therefore, the committee was of the view whether we should come with a guidance note, because guidance note is generally only addressing those areas which are in the Form 3CD, which is a notified form. There may be certain clauses which may be coming up in the utility, but they are still not in notified forms. Those we are not covered in the guidance note. If you may look into a preamble, it's very important. So now, obviously, the revised Form 3CD has come. Certain revisions have been made in certain clauses, including 43 capital B, subclause H has been included. So our committee would be looking into it, and will definitely come with some publication. Obviously, if it's a guidance note, maybe a supplemental guidance note, which we may try to cover all the amendments which have been made in Form 3CD by way of the notification 2 days earlier, or we may come with a technical guide. As you may not be aware, for the general interest of the members, for the purpose of the technical guide, generally a committee is authorized by the council to come with such technical guides, because technical guides are recommendatory in nature. But in case we have to come with a guidance note, which is on higher pedestal, when we talk of the authority attached to any publication issued by ICAI, guidance note are on higher pedestal. So when I say higher pedestal, obviously before coming up with a guidance note, we have to come with an exposure draft thereof. That exposure draft is open to all the members to comment upon it. After comments are come, those are incorporated, discussed by the committee finalizes it, then it goes to the council. So generally for coming up with a guidance note, it may take 3 to 4 months. So our committee will take a decision whether we should come with a technical guide to be more quicker, so that at least we are able to come with some guidance, though maybe recommendatory, but some guidance will come on these aspects which have been amended. Further, there was other discussion happening whether the guidance note we should come with a supplementary at this stage, because it is expected that there would be further changes coming up in the month of June when the full budget comes up. So generally, we revise the guidance note after the budget to incorporate the changes in the law which is happening. So anyways, definitely you may expect something coming up, maybe technical guidance note on these issues. And we'll also cover issues in regard to other amendments made and which are applicable maybe through a notifications or circulars in this. We will be forming a group soon on this. We'll also look forward to whatever suggestion come from each and individual members. You can write to us on dtc@ici.in. I assure you our team will try to compile that and try to discuss it with the group members, experts who would be roped in for preparing this technical guide and this guidance. Apart from this guidance note, obviously, as you may be aware, last year when the audit reports for the charitable trust where forms were notified, which were the new forms, quite lengthy. In a way, it was not an audit report, but you were actually certifying computations in form number 10B and 10BB. We decided, considering the time constraint, which I had explained for bringing in the guidance note, we decided, the then chairman, CA Sanjay Agarwal ji, whom I would acknowledge, who worked very hard on that technical guide, and he himself studied each and every line one by one before releasing that technical guide, and it was made as if it is a guidance note. But we came with a technical guide. Now, and after last year itself, we decided that we'll convert this technical guide into a guidance note, which becomes more, rather from a recommendatory to becomes more in a mandatory nature. Though guidance note are termed as recommendatory, but the auditors are expect to follow the guidance note. And if you're not following the guidance note, it is very necessary for you to document what alternative procedures you have done for reporting under that particular clause. And therefore, my request always has been, please follow the guidance note in toto. Irrespective, your views may be different. So taking it that forward, this year already certain groups have given their comments for converting this technical guide to guidance note. Soon, within 2 or 3 months next, which is our target, we may come with this guidance note on this audit report in form number 10B and 10BB. That's what our target for an action plan also for this year's committee. Because we have 3 to 4 months in which all we have to do, audit reports would be due by 30th of September. So obviously we do understand the urgency on that, and we'll try to bring it as soon as possible with the support of all the experts, co-opted members, special invitees who would be on this particular committee. As I said earlier, that this committee has also merged with International Tax Committee. We have identified for this year 3 to 4 publications, which we propose to revise, number one. So we will be doing that. Secondly, plus on the transfer pricing, individual area-wise, industry-wise, also whether we should bring out with the publication that has been discussed at the committee level. If the committee approves, then definitely we'll try to bring certain publications also. My request to all of your members, whenever you are discharging your taxation functions, maybe tax compliances, tax advisory, maybe audit and assurance, which is in relation to direct tax, please do look into these publications. I'm sure it will help you professionally also, and it will also actually ring fence you when you are defending, if you have been put to questions by the regulatory bodies, that how you have provided these assurances. It will help you that you can always tell, you can always fall upon that this material is issued by the institute which you have followed, and therefore no action can be taken against you. So that would be my suggestions. Apart from this, Direct Tax Committee, as you know, we already have a course on Diploma in International Taxation, which is very much recognized. And we do also conduct this in physical mode and also in the online mode also. Yesterday, of course, in the ANCOM and today council, I believe that they will again approve online mode. Generally, the council was of the view we should do more physical programs because there is more interaction and more knowledge can be shared. But online course will be launched soon because it may be approved by the council today. Today we have a council meeting for that also. If it gets approved, we'll also come up with further diploma courses in an online mode wherein at least 200 members can get it registered. Apart from that, we had come with a certificate course on UAE corporate tax for the members who are interested in actually learning UAE corporate tax to provide services in those areas. You may please join and please look forward to our website in this regard. and please do join and register for it. Coming to the another action plan this year, and also last year, we always felt that we should be more proactive, and a lot of members also feel that whether institute and the direct tax committee is actually proactive, and whether they are continuously talking to the department, because a lot of issues our members face, though it may be affecting their necessity. But I know, as you're being your clients, you are always worried, and you are also worried when it comes to talking about the nation, that ultimately there should be ease whenever the tax filing is concerned. So yesterday we had a meeting with the CBDT chairman, wherein president, vice president, myself, and my vice chairman, Mr. Sri Kota Srinivas, also joined, and Mr. One council member, CV Chitle, was there. There was a very good discussion on it. We discussed all the initiatives about the direct tax committee. We also discussed on the pre-budget memorandum very briefly, and they have assured us that they will give us a separate time slot, maybe 1 hour or 2 hours, to discuss whatever are our suggestions on pre-budget memorandum in the last week of March. So tentatively, we'll be discussing. Our idea is, if we can be proactive and give us suggestions which can improve the tax collections, which can tax evasion can come down, administrative ease can be brought in the tax law, then those suggestions goes from our committee as a pre-budget memorandum. And again, we take up views from various experts who are the members of the institute. We incorporate that. So this also we will be discussing, as assured by the CBDT. Other than this, of course, they have also promised from the policy department we can have meetings with the CBDT on a quarterly basis. So whatever issues that arises on a quarter-on-quarter basis can be compiled and can be discussed and sorted in a manner. So this, I thought, as a briefly for the benefit of the members, I would just briefly touch upon certain action plans which will be tried to cover during this year of the Direct Tax Committee. And I would assure all the members, you are free to write, approach chairman, vice chairman of Direct Tax Committee for any issues at any point of time. You can write to dtc@ici.in. We generally try to compile all the grievances which come from the members. We also try to make various representatives. I'll just give you an example that you may recollect. As far as trust is concerned, the new audit report came last year for the first time, and a lot of members, we received a complaints from the members that we had filed a wrong form. So instead of 10B, they have filed 10BB or a vice versa. So the DTC represented to them that please condone that either of the form has been filed, the return should not be treated as defective, or the 143(1) adjustment should not happen, or the extension should be granted for filing a new form. So they have accepted our such a representation, and they come for with a notification 2 days back, wherein they have said that if you have filed 10B and the correct form was 10BB, you may file it before 31st March 24. So the CBDT is considering our representation. Our duty is to represent adequately with proper facts, why suggestions, what suggestions are there, what rationale is that. So we'll try to do that. That would be my endeavor for this particular year. So thank you very much for joining us. Again, my thanks to CA Rajeshji Mehta. I'm sure this would be a wonderful discussion in next 1.5 hours. Thank you, Gaurang, who has agreed to be a moderator and who would be also taking questions sessions. I'm also joined with my vice chairman, Kotaji, whom after me, I would request him to address the esteemed members. Thank you very much. Thank you.
Thank you, Chairman. I welcome CA Gaurang Shah, the moderator for this particular session, and also CA Rajesh Mehta, who will be the speaker for this session. I think our chairman of the DTC has given the action plan for the year, so I need not again echo the same things. Definitely, one thing I can say, with the leadership of Piyush and other committee members, whatever is for the benefit of the profession, we will definitely try to do all those things. As he said, the members also should come to us or get in touch with us and ask us what is required, technically what support we can do, and we will do all those things. Coming to today's topic, we have this presumptive taxation 44AD and 44ADA, which Rajesh Mehta sir will take you through that particular topics as such. And if you have any queries on those topics, kindly request all of you to share those queries, so that if it is more number of queries are there, we can even bring out a small publication on these 44AD, 44ADA with the FAQs as such. This presumptive taxation law came a long back. Maybe I don't remember the first time when it was brought. Maybe I think 15 to 20 years back, it started with for the small vendors, small assessees, paying some 1,400 rupees as a 1 year taxation as such. Then it started for the business people, then for the goods transport operators and some contractors. Now, of late, it has come for even professionals. 44AD and 44ADA is the two sections, main sections of presumptive taxation, where the day-to-day practices get affected because most of the firms deal with these type of clients. So there may be a lot of intricacies in that. There are a lot of interpretations in that, and there may be a lot of what I should say amendments over a period of time. So to know all those things, more about that, and to understand in detail 44AD and 44ADA, CA Rajesh Mehta is there with us. Once again, welcome you, sir, on behalf of the DTC, on behalf of ICA, and on behalf of all the members present here. I wish this 2 hours of your discussion throws a lot of information to the members. And one thing I think our chairman forgot to say is that we are planning to have weekly sessions. Maybe in other things he would have forgotten that. Any member who is interested to speak in these forums, webinars, kindly get in touch with us. And anybody who wants to even be participative as a moderator also, please get in touch with us. We will try to accommodate and give preferences to all the younger speakers. We would like to get some young speakers so that every week means at least 45 to 50 is what our chairman said. We will try to organize such particular webinars. Thank you once again for giving me this opportunity.
Thank you very much, Kotaji. I'll just, for the benefit of the speaker, your of the 2,100 participants who are watching you live. I thought I'll just pip in. Gaurangji, you can please take it. Thank you.
Thank you, sir.
Thank you so much to our chairman and vice chairman for their opening remarks. Now, I would request our today's speaker, Rajesh Mehta, to please take over this session. Thank you, sir. Rajesh sir, you are on mute.
Oh, sorry.
So, respected DTC Chairman CA Piyush Chhajed ji, respected Vice Chairman CA Kota Srinivas ji, moderator of the session CA Gaurang Shah ji, and all the professional colleagues. Today's topic, the navigating presumptive income provisions under section 44AD and 44ADA. So these sections look so simple. We think that these are so much easy topics that we should take the turnover and put the specified percentage of 8% or 6%, and we are able to file the income tax return within a minute. But it is not so easy. There are so many if and but. First of all, we have to decide, then we can proceed to file any income tax return. So a lot of work and lot of preparations has to be done to reach to this conclusion that whether our assessee falls under section 44AD or 44ADA, or whether he will have to get his books of accounts audited, under which clause his books of accounts are to be audited, whether 44AB or whether 44AB clause A or clause B or C, D, which clause is applicable. So a lot of preparations are required before proceeding to 44AD or 44ADA or 44AE. So some routine things also I will be discussing, and some routine technical problems we face in our day-to-day routine, that also I will be discussing. So who is eligible to opt for the section 44AD? Any individual, HUF or partnership firm, not being LLP, having the turnover limit specified, can opt for the 44AD. So he has to declare his income of the 8% or 6%. If the eligible person has received all the amounts either through banking channel or through online payment systems as specified under Rule 6A before the due date specified under Section 139 subsection 1 of the Act, then he is required to declare his income at the rate of 6% of the such turnover. If any of the amount has been received in cash or by any other mode other than banking channel or other than the mode specified under Rule 6A, then he has to declare 8% of the income of his gross turnover or gross receipt. If any of the amount is outstanding, even up to the due date of filing of income tax return as specified under Section 139(1) of the Act, that amount also has to be covered under the rate of 8%. So whether the provisions of Section 28 to 43C will be applicable if any person is opting for 44AD. So 44AD section starts with a non-obstant clause. Section 44AD subsection 1 states that notwithstanding anything contained in Section 28 to 43C. So therefore, there is any violation or any disallowances which gets attracted under Section 28 to 43C will not be disallowable if any of the person has opted for Section 44AD. Therefore, if, say for example, any of the retailer has purchased some of the goods in cash in excess of rupees 10,000 or by way of mode any other through other than the banking channel, even though Section 48 subsection 3 will not be get attracted under Section 44AD. Or say for example, any of the partnership firm has made payment to contractors but have failed to deduct the TDS on payment to contractors. But there will not be any disallowance under Section 48 Roman 1A because any disallowances covered under Section 28 to 43C will not get attracted here. But if any of the person who is liable for TDS but fails to deduct TDS, however, he will not be covered under disallowances, but interest under Section 201 subsection 1A or Section 206C subsection 7 or TDS penalty under Section 271 capital C or 271 capital CA may be applicable on him. So they must follow the TDS provision even if they are not liable for audit, because any of the person whose turnover is exceeding rupees 1 crore, he will be covered under TDS provisions, or any of the partnership firms, even if whatsoever their turnover, they are liable for TDS provisions. So they must follow the TDS provisions even if there will not be any disallowances under Section 48 Roman 1A. Whether any individual HUF or partnership firm not being LLP engaged in the business having turnover of rupees 1 crore or less not opted for 44AD is required to get books of accounts audited if his income from such business is less than 8% or 6%. So many a times we come across this question that whether if the turnover of any of the assessee who is eligible to opt for 44AD, but if his turnover is not more than rupees 1 crore, then whether he is required to follow the 44AD provisions, or whether if his profit is less than 8% or 6%, is it compulsory for him to get his books of accounts audited? No, he is not required to get his books of accounts audited if this is the first year of his business and his turnover should not exceed rupees 1 crore. Or if the assessee has not opted for 44AD in any of the 5 immediately preceding previous year. If assessee has not opted for 44AD in any of the preceding 5 years, then also he can declare his profit less than 8% or 6% by simply furnishing his profit and loss account and trading account figures and balance sheet in his ITR 3 form. So he will have to fill up the profit and loss account balance sheet, because as per section 44AA subsection 2, even if any person is not required to get his books accounts audited, he is required to maintain such books of accounts which may enable the assessing officer to compute his taxable income. And if he is not covered under 44AD, he has to maintain the books and file the profit and loss balance sheet, etc. in his ITR. Is it compulsory to follow 44AD in subsequent year or years if the assessee has opted for 44AD in the current year? Yes, if any of the assessee has opted for 44AD in the current year, if he wishes to remain in 44AD in forthcoming years, then he has compulsorily to follow 44AD. If once he has come out of 44AD, he has declared profit less than 6% or 8% in any of the year, then he cannot opt for 44AD in succeeding 5 assessment years. So in succeeding 5 assessment years, he will compulsorily have to get his books of accounts audited. What is the rule regarding maintenance of books of accounts by specified professionals? The specified professionals have been defined under section 44AA subsection 1 of the Income Tax Act. As per rule 6F, every person who is carrying on the profession of legal, medical, engineering or architecture profession, or the profession of accountancy, technical consultancy, interior decoration, film artist, authorized representative, company secretary, or information technology professional, they are required to maintain the books of accounts. They have to maintain the cash book, ledger, journal, copies of bills, serially numbered, original bills or receipts or vouchers in respect of expenditure incurred. Any person who is in medical profession, he is also required to maintain the form number 3C. And such books of accounts have to be kept by such professionals for a period of 6 years from the end of the relevant assessment year. The said time limit is applicable only to the specified profession. Therefore, any of the person who is a specified professional, CA, doctor, engineer, advocate, or company secretary, or the information technology professional, film artist, they are required to maintain their books of accounts for a period of 6 years. However, for the non-specified professionals, any of the professional who is not covered under 44AA subsection 1, or any of the businessmen, the Income Tax Act or Income Tax rule has nowhere specified that such businessmen or such non-specified professional are required to maintain their books of accounts for how long period. So Income Tax Act has not made any such provision. I have not came across anywhere that for these businessmen or these non-specified professionals shall have to keep and maintain their books of accounts for how long. However, section 44AA subsection 2 states that such business person or the non-specified professional are required to maintain such books of accounts which may enable the assessing officer to compute the taxable income. So if any of the person who is carrying on the business or who is a non-specified professional covered under section 44AA subsection 2, if he is an individual or HUF carrying on the business or non-specified profession, he will be required to maintain the books of accounts if his income exceeds rupees 2.5 lakh or his turnover or gross receipt exceeds rupees 25 lakh. Or if any of the person who is not an individual or HUF carrying on business or non-specified professional will have to maintain books of account if his income from business or non-specified profession exceeds rupees 1.20 lakh or his turnover or gross receipt exceeds rupees 10 lakh. Can an individual being a commission agent opt for section 44AD? No. Any commission agent cannot opt for section 44AD. Such individual has to maintain books of accounts if his income from business exceeds rupees 2.5 lakh or his gross receipt exceeds rupees 25 lakh, and he has to get them audited if his gross receipt exceeds rupees 1 crore. Say for example, if the gross receipt of any of the commission agent is only rupees 20 lakh and his net profit is rupees 8 lakh. So whether he will be required to maintain the books of accounts? No, because he will not be, if his gross receipt is 20 lakh and his net income from the commission is rupees 2 lakh only, then he is not required to maintain the books of account. He can declare his income in the no accounts case. But if his gross receipt or net income is exceeding rupees 2.5 lakh or gross receipt exceeding 25 lakh, then he is required to maintain the books of accounts. So he will have to fill up the profit and loss account and balance sheet in the ITR 3. Any person who is a commission agent or a specified professional also having business income eligible for 44AD, can he simultaneously opt for Section 44AD for that business income? So Section 44AD, subsection 6 says that the commission agent cannot opt for 44AD. So this is correct. But can any person simultaneously opt for the 44AD for his eligible business covered under 44AD? Simultaneously, he may file the profit and loss account or no accounts case for his commission agency business. So as per Section 44AD, because Section 44AD word under Section 44AD subsection 6, the word used has been person. The person who is covered, who is a commission agent, cannot opt for 44AD. So the drafting of Section 44AD 6 seems to be wrong, because it says that any person who is a commission agent cannot opt for 44AD. So this should have been a different drafting. But the income tax portal, the income tax utility allow us to opt for 44AD as well as commission, no accounts case commission agency income simultaneously. So if the portal allows, we can assume that the income tax portal is the mirror of the Income Tax Act. So if the portal is allowing us simultaneously adopting the 44AD and 44ADA and commission agency income, we can file, because otherwise the portal should have itself stopped us. Who can opt for Section 44ADA? Can he opt 44ADA in subsequent year if he has not followed 44ADA in current year? Any of the individual or HUF or a partnership firm not being LLP carrying on a specified profession. So any HUF, one thing I would like to correct here, that any of the HUF cannot carry out the 44ADA. So any individual or a partnership firm not being LLP can carry out the 44ADA, can opt for the 44ADA, because earlier the HUF was also covered, but from the Finance Act 2021, the HUF word has been omitted from this 44ADA. So any individual or a partnership firm not being LLP, having gross receipt not exceeding rupees 50 lakh, can opt for Section 44ADA and has to declare a minimum of the 50% income of the gross receipt from such profession. So 44ADA is applicable only to the specified professional covered under 44AA subsection 1. Specified profession are the legal, medical, engineering, etc., which we have already discussed. If he declared less than 50% of the income, then if his total income exceeds the maximum amount not chargeable to tax, he will have to get his books of accounts audited. He may opt in any year and opt out in any year. So as we have discussed in 44AD, that if anyone has opted for 44AD, he cannot come out of this 44AD in subsequent 5 years. And once he has came out of 44AD, then he cannot opt the 44AD in succeeding 5 years. But in the 44ADA, every year the option can be changed. If in any year anyone is having lesser income, he can go for audit. In subsequent year, if he is having income of 50% or more, he can opt for the 44AD and declare his income of the 50%. From the assessment year 2024-25, one relaxation has also been given under 44ADA, that if aggregate of the amount received in cash during the previous year does not exceed 5%, cash amount received does not exceed rupees 5% of the total gross receipt, then up to rupees 75 lakh of the gross receipt, there will not be any need of audit under section 44 ADA. So up to 75 lakh, any specified professional is not required to get his books of accounts audited if he declare his income of 50% or more from assessment year 2024-25. But for the specified professional, TDS is applicable above 50 lakh. Even if any specified professional is having receipt between 50 lakh to 75 lakh, he has opted for 44 ADA, but TDS provisions will be liable for him if his gross receipt is exceeding rupees 50 lakh. So provisions of 194A, 194C, 194J will be, or 194I will be applicable if his gross receipt is exceeding rupees 50 lakh, even if he has opted for 44 ADA up to rupees 75 lakh. What if the assessee wants to opt for 44 AD, having turnover up to rupees 3 crore, and his aggregate of cash received during the previous year is not in excess of 5% of total turnover or gross receipt, but recovery of debtors outstanding at the end of the previous year is not realized up to due date? So I have given a detailed example here, because from the assessment year 2024-25, for which we are going to file the income tax return after this 31st March 2024, one relaxation has been provided for presumptive income under section 44 AD, that the limit has been increased up to rupees 3 crore. But there is a condition that the aggregate of the cash received during the previous year is not in excess of 5% of the total turnover or gross receipt. But there are some conditions also. So here I have given example that if any of the person has received some amount in cash, first of all, during the current previous year, his cash receipt should not exceed rupees 5%. So cash receipt means any of the recovery of the previous year's debtors, any amount received from unsecured loans, or any sale of fixed asset, any amount cash received, including turnover. If it is in excess of 5%, then turnover limit will be 2 crore only. If it is not in excess of 5%, then turnover limit will be applicable rupees 3 crore. But if amount has been received in subsequent year in the cash, in this example, you will see that in financial year 24-25, the cash received is rupees 30 lakh. So if 30 lakh has been received in the next year, so even though you will not be debarred from opting this rupees 3 crore limit during current financial year 23-24, assessment year 2024-25, maybe you may not be eligible to opt for this 3 crore limit in the succeeding year, because this rupees 30 lakh has been received in subsequent financial year. So this example, because some time is less, so I will not discuss this. My write-up will be shared to all of you by DTC. So I am not discussing this example here in detail. So I have given here another example. So if any amount, if anyone is opting for 3 crore limit and any amount is due even up to due date of filing of 139(1) ITR, then that amount will be liable for 8%. Or any amount received in cash will also be liable for 8%. Any amount received by way of banking channel or as per the various channels specified under Rule 6A will be liable at the rate of 6% only. When is a person carrying on business required to get his books of accounts audited? So whether our assessee is eligible for opting 44 AD or not, we also have to keep in mind the provisions of section 44 AB also. So if any of the assessee is having turnover exceeding rupees 1 crore, he is required to get his books of accounts audited. But if that assessee is not having turnover exceeding rupees 2 crore and he has opted for 44 AD, then he is not required to get his books of accounts audited. Or if any person is having sales turnover or gross receipt not exceeding rupees 10 crore and aggregate of all payment received, including towards sale turnover gross receipt in cash, does not exceed 5% of the said amount, and aggregate of all payment including towards expenditure in cash does not exceed 5% of the said payment. check or draft which is not account pay shall be treated as cash. So any person having turnover up to 10 crore is not required to get his books of accounts audited if his aggregate of receipt and payment in cash is not exceeding 5% of the such amount. So in calculating the 5% of aggregate receipt or aggregate payment, we have to include the for receipt, we have to include the unsecured loan, we have to include the amount received by way of sale of any fixed asset, or any of amount received from previous year's debtors also is covered to determine this 5% limit. Or if we are making any payment of 5% in over and above the cash, so to determine this 5%, the aggregate of the sale, aggregate of the purchases, aggregate of the payment to current year's creditors or previous year's creditors or purchase of any fixed assets, all these amounts have to be included and 5% will have to be worked out of that payments. Whereas, as regards the limit of rupees 3 crore covered under 44AD, the 5% has to be calculated of the whole gross receipt, including the 5% has to be calculated of the total turnover. So only turnover is to be determined for that of the turnover. And here the aggregate of receipt, 5% of aggregate of receipt. And for 3 crore, we have to calculate 5% of total turnover. So this is the difference also here. If any individual or HUF or a partnership firm not being LLP during previous year has aggregate cash received during the previous year not exceeding 5% of total turnover, so we have already discussed this 3 crore, who can opt for 44A. So this is also very routinely used provision by the persons involved in transportation of goods by way of the goods carriages. So any person who owns not more than 10 goods carriage at any time during the previous year and engaged in plying, hiring or leasing of goods carriages has to declare minimum income of rupees 1,000 per ton of gross vehicle weight per month for heavy goods vehicle. And for other than heavy goods vehicle, minimum rupees 7,500 per month is required to be declared. Books of account has to be maintained and audited if lower profit is declared. In case of a firm, salary and interest is also separately allowable as per section 40 clause B. Under section 44 AD, if any partnership firm is opting for section 44 AD, then they are not allowed any remuneration or interest out of the 8% net income. But for the purpose of section 44 A, partnership firm is allowed salary and interest. And any of the private limited company or any of the assessee, even LLP, can opt for section 44A. Even if the gross receipt of any of the person opting for 44A is exceeding rupees 3 crore, but he doesn't own more than 10 goods carriage at any time during the previous year, then he is eligible to opt for 44A. So gross receipt is not a criteria for the determining the limit of 44A. So heavy goods vehicle means any goods carriage, the gross vehicle weight of which exceeds 12,000 kilograms, so that is 12 ton. So one problem we used to came across during last 4 or 5 years, we had a lot of problem of CPC making prima facie adjustment due to wrong deduction of TDS under wrong section. If TDS is wrongly deducted under section 194J, whether the assessee is bound to offer income under 44 ADA, or can CPC make prima facie adjustment under 143 1A6 by converting section 44 AD to section 44 ADA? No. The Finance Act 2017 has, with effect from 1st April 2018, the section 43 1A6 has already been abolished, so already been made inoperative. Earlier to this, CPC was making adjustment. Earlier to this, CPC was making adjustment, and many of the assessees had to face various appellate stages, and there was a lot of litigation due to so many, because Section 143, 1A6 had made a provision that if there is any inconsistency between the figures under 26AS or Form 16A or Form 16, then higher figure, if it is there in 26AS, 16A or Form 16, that has to be taken to determine the income by CPC. So ITT Chennai in case of PVN Associate, and there are so many ITT judgment or they may, even High Court judgment, which said that CPC has no authority to make prima facie adjustment. Even earlier to this deletion of 143 1A6, ITT Chennai came out with the judgment and various other benches came out with judgment that CPC has no authority to make this prima facie adjustment. If the assessee has wrongly opted for Section 44 AD in place of Section 44 ADA, whether CPC can issue notice under Section 139 subsection 9 of the Act. So in my opinion, CPC has no authority to issue any notice under Section 139 subsection 9 of the Act. Only the jurisdictional assessing officer can issue a defective return notice of Section 139 subsection 9. However, we come across during last 5-10 years that CPC has issued so many notices of Section 139 subsection 9. So it has caused a lot of problem to various assessees across India. And if any of the return has been treated as defective, then assessee has no option to go to the CIT appeal or to ITAT. The only option left with the assessee is go to the High Court. He can challenge the defective return of 139 subsection 1 only before the High Court. There is a judgment of Gujarat High Court recently in which Gujarat High Court has instructed the CPC to allow the assessee to file a revised return because he was not allowed to rectify his return. Therefore, the Gujarat High Court told that his return may be allowed to be revised. And there is one judgment of Jaipur ITAT. In that case, the assessee had filed his return and his turnover was less than ₹1 crore, even though CPC treated his return as a defective return and his return was treated as defective. Then the assessee filed the rectification application under Section 154 of that. Then the CPC rejected that application. Assessee went into appeal before CIT appeal. CIT appeal also dismissed that appeal. Then assessee went in appeal before the ITAT. ITAT held that this is a mistake apparent on record because his turnover is less than ₹1 crore. So he is not required to get his books of accounts audited. So his return cannot be treated as defective. Then ITAT allowed this 154 application and treated the return as not defective under 139(9). But there is a contrary judgment of Pune ITAT. ITAT Pune held that once the return of assessee has been treated as defective, there is no provision under Section 246A of the Act to file any appeal before the CIT appeal against the defective return under Section 139(9). So if it is covered under Section 154, then you can go for ITAT and ITAT may allow your if it is mistake apparent on record. If your return is defective and there is no mistake apparent on record, you have only the option left to go to the High Court. Whereas CPC has no authority to treat the return as defective. Whether a private limited company providing medical services or running a hospital is a profession specified under Section 44AA subsection 1. No. Any of the private limited company carrying out medical services or running a hospital is not a specified profession. So if any of the person is making payment to any hospital, it is not covered under 194J. It is covered under 194C because any private limited company is not a person covered under 44AA subsection 1. It is a person, it is covered under 44AA subsection 2. There is a judgment of ITAT Delhi in the case of CIT versus Ashalok Nursing Home Private Limited. In that case, ITAT held that a company being an artificial person does not have a mind or a body, therefore cannot be engaged in a profession. It can neither have an intellectual skill or manual skill. Therefore, company is not a professional and provisions of section 44AA subsection 1 rule 6F are not applicable to a company. Therefore, such hospital is the limit of rupees 50 lakh is not applicable to such hospital. However, private limited is not now not allowed to opt for 44 ADA, and 50 lakh limit is because section 44 AB clause B specifies only the word profession. It does not specify the word specified profession. So any of the private limited company can also be covered under profession, but it is not covered under specified profession, and it is a business. Therefore, provisions of section 44 AB clause A are applicable to that company. And if their turnover is exceeding 1 crore, then they are required to get their books of accounts audited. And such private limited company is not required to maintain the form number 3C also. A doctor running a nursing home also engages other doctors, whether this nursing home activity be treated as business or a profession. There is a judgment of ITAT Jodhpur in this case. In the case of Sunil Chandak versus ITO, they have stated that if any of the doctors have been engaged on independent standalone basis or substantially so, then it is a business. If the doctors have been engaged not on independent basis, their services are only of the facilitative nature, then such doctor will be covered under 44AA subsection 1. But if such doctor have taken the services of other doctors on independent or standalone basis, then it will be covered under the business. So therefore, if the services of doctors are taken independently, standalone basis, or substantially so by a nursing home being run by a doctor, such nursing home would be treated as carrying on the business. Whether business includes profession or vocation. Unless otherwise specifically excluded, business includes profession. There is a judgment of ITAT Pune in the case of Gera Development Private Limited, which have discussed that business includes profession. So, which have in that to support the in that judgment, they have referred various Supreme Court judgment also. On the basis of these judgments, they have stated that the business, always profession is covered under business. Any business cannot be a profession, but profession is always covered under business unless otherwise specifically excluded. So they have referred various judgments of various other courts. So I have discussed this case law here and this question here because any of the person who is not a specified profession, who is not covered under 44AA subsection 1, say for example, any of the person who is in a teaching profession, who is a lecturer giving lectures in a college, his TDS is deducted under section 194J, but he is not a specified professional. He is carrying out profession, but he is not a specified professional. So he can declare his income under section 44 AD because 44 AD subsection 6 specifically excludes only specified profession specified under section 44AA subsection 1. Therefore, any of the person engaged in profession which is not a specified profession is eligible to opt for 44 AD. Even up to rupees 3 crore, he can opt. Otherwise, any of the professor, if he is receiving the gross receipt of 60 lakh, he will have to opt for, or receiving a gross receipt of rupees 40 lakh only, he will have to go for 44 ADA. But by these case laws, we can determine that because he is not a specified profession, therefore he can be covered under 44 AD. Or he can opt for the specified limit of tax audit specified under 44 AB clause A. However, section 44 AB clause B specifies only the word profession. it does not specify the word specified profession. But on the basis of these case laws, we can say that business includes profession. Therefore, any person who is carrying out non-specified professional is covered under 44AB clause A or is covered under 44AD. Whether HUF, running pathology, is a business or a profession. Can penalty under 271 be levied if HUF is running a pathology and gross receipt exceeding the limit specified for professional? So if HUF is treated as a professional, then the limit of rupees 50 lakh will be applicable. If it is treated as a business, the limit of rupees 1 crore will be applicable, or limit of rupees 44AD specified under will be applicable for that business. So there is a judgment of ITAT Lucknow. In that case, it has stated that HUF running a pathology is not a profession. It is covered under business. Whether a sports person are liable under 194J, 44AA subsection 1 or 44AA subsection 2 or 44AD or ADA or rule 6F. So sports person are professional only for the purpose of section 194J. However, section 44AA subsection 1, which is applicable to the specified professional, is not applicable to sports person. Therefore, sports person are covered under 44AA subsection 2. Even if their TDS is deducted under 194J, they can opt for section 44AD. Teaching profession, as I have already discussed, that teaching profession is covered under 44AD. Even if their TDS is deducted under 194J, they can opt for 44AD. So limit of rupees 50 lakh will not be applicable to them. Some of the ITAT judgments I would like to discuss here. There is a judgment of ITAT Bangalore in the case of Girish V. Yellaki Shettar versus ITO. In this case, the assessing officer made his assessment under section 44AD of the Act, as well as made the additions under section 68 of the Act for unexplained cash credit. But ITAT held that if the scheme of presumptive taxation has been applied to any assessee for his turnover, then such turnover cannot again be subjected to section 68. Any addition under section 68 cannot be sustained for presumptive income. There is a judgment of Haryana High Court in the case of CIT versus Surinder Pal Anand. Whether any assessee is required to explain each and every entry in his passbook. So Haryana High Court has held that if the return of income of the assessee has been accepted under section 44AD of the Act, his assessment has been completed under 44AD, then he is not required to explain each and every entry of his bank passbook. If all such entries are covered under 44AD turnover. If those entries are not covered under 44AD turnover, then he may be required. But if all these are part of the turnover of 44AD, then he is not required to explain, even if that amount has been received in cash or that amount has been received through check, or even if no TDS has been deducted on that amount and that amount is not reflecting in the 26S, even though it is not, he is not required to explain such entries. The Chandigarh bench, in the case of Nandlal Popli versus DCIT, they have held that if any of the return has been accepted under section 44AD of the Act, then can the assessing officer make any addition under section 69C of the Act towards unexplained expenditure? So ITAT Chandigarh held that if the assessment has been completed under section 44AD of the Act, then the assessing officer cannot make any addition under section 69C of the Act for any of the expenses by holding it as an unexplained expenditure. Because they have discussed it in very detail. They have stated that a sum equal to 8% of the total turnover or gross receipt of the assessee in the previous year on account of such business, or as the case may be. A sum higher than the aforesaid sum claimed to have been earned by the assessee, eligible assessee, shall be deemed to be the profit and gain of such business chargeable to tax under the head profit and gain of business. Any deduction allowable under provision of 30 to 38 shall, for the purpose of subsection 1, be deemed to have been already given full effect to, and no further deduction under those sections shall be allowed. The provision of above section are quite unambiguous to the effect that in case of an eligible business based on gross receipt turnover, the income under the head profit and gain of business shall be deemed to be 8% or any higher amount. The first important term here is deemed to be, which proves that in such cases there is no income to the extent of such percentage. Because many times the assessee is not having income up to 8%. He may be having income of 1% or 2% or 3%. Even though he is declaring his income up to 8% to opt for this simplified scheme of 44 AD. However, to the extent income is deemed, it is undisputed that deemed means presuming the existence of something which actually is not there. Therefore, it is quite clear that though for the purpose of levy of income tax, 8% or more may be considered as income, but actually this is not the actual income of the assessee. This is also the purport of all provisions relating to presumptive taxation. Further, ITAT have told this very important para number 11 of that order. I am reading out that para. Putting the above analysis in converse, it can be easily inferred that the same is also true for the expenditure of the assessee. If 8% of gross receipt are deemed income of the assessee, the remaining 92% are also deemed expenditure of the assessee, meaning thereby that actual expenditure may not be 92% of gross receipt. Only for the purpose of taxation, it is to be considered to be so. To take it further, it can be said that the expenditure may be less than 92% or it may be more than 92% of the gross receipt. So his expenditure may be more than 92% or less than 92%, even though the assessing officer is bound to assume that 92% have been spent if the assessee has declared 8% of his income. So assessing officer cannot say that your expenditure is less than 92% or more than 92%. So ITAT further told that, further, on reading on the substantive part of the provision, it is quite clear that an assessee availing the benefit of such presumptive taxation claimed to have earned income of 8% or above of the gross receipt. In that case, the provision of subsection 5 of 44 AD will be applicable. In the instant case, the provision of 45 will be applicable, which read as under. Notwithstanding anything contained in the foregoing provision, an eligible assessee who claims that his profit and gain from eligible business are lower than that, then he will be required to maintain his books of account, and then he will be required to explain the expenditure, each and every entry of the expenditure also. So from the combined reading of subsection 1 and subsection 5, it is apparent that obligation to maintain books of account and get them audited is only on the assessee who opt to claim the income less than 8% of the gross receipt. So here I want to say that even if the assessee has spent less than 92% or more than 92%, the assessing officer has no authority to inquire any of the expenditure if he is satisfied about the gross receipt and if he has covered his case under section 44 AD of the Act. But at the same time, we should keep in mind that we should not promote our assessee that he should spend less than 92% and create his money and purchase immobile properties or purchase any other valuable asset out of that money. Because if it is all the routine business transaction and if coincidentally the amount has been spent more than or less than 92%, then it will be routine business. But if assessee take it as a capital accumulation system, if he take it for granted, then in future there may be some adverse ITT judgment also, so we should take caution also that the assessee should not misuse this relaxation. Section 69A, ITT Cochin in the case of Thomas Ipan, Alpuja. In that case, for making the impute addition, has stated that there was total deposit of 94 lakh and assessee has only expended about 66 lakh and rupees 27 lakh being balance unexplained. So there was gross receipt of rupees 94 lakh. Assessee could explain only rupees 66 lakh. And remaining 27 lakh he could not explain. But he covered this 27 lakh in the 44 AD. So ITT held that the assessing officer cannot make any inquiry of this 27 lakh if it is covered under 44 AD. And in the same manner, he cannot inquire about the expenditure. He will have to, he cannot ask for any expenditure whether he have actually incurred or not. It is only the presumption that amount of 92% of gross receipt was incurred by the assessee. ITT Cochin, in the case of Thomas Ipan, 113 taxman.com to 68 Cochin bench, it was held that assessee is a small trader of medicine falling under 44 AD, offered his income on presumptive basis, so provision of 69A should not be applied to make the addition in respect of the undisclosed cash credit found, because cash credit itself is covered under 68, but the assessing officer made addition under section 69A, even though if it is covered under 44 AD, no addition can be made under 68 or 69A. There is a very interesting case. If turnover is more than upper limit of 44 AD, say for example, the upper limit of 44 AD is rupees 3 crore. If the assessee is having turnover of rupees 10 crore and he has not got his books of accounts audited, but the assessing officer has opted the rate of 8%. So if turnover is exceeding the limit of rupees 2 crore or 3 crore, then 44 AD cannot be opted. But if the assessing officer himself has taken the rate specified under 44 AD of rupees 8% or 6%, then whether can the AO make any disallowances in addition to that? No. If the assessing officer has adopted the rate of 8%, not 44 AD, because if turnover is exceeding rupees 2-3 crore, then 44 AD cannot be opted, but rate of 44 AD can be opted. So in this judgment, the assessing officer adopted the rate of 8%, even if the turnover was exceeding the limit specified under 44 AD. So ITT held that any addition cannot be made, or the assessing officer cannot take the income of 40% without taking other comparable cases or the comparable cases of the assessee itself of the previous years. If there is no other comparable cases of other assessee or of other year of the same assessee, then the rate of 40% cannot be applied. For this judgment, ITT referred a very landmark judgment of Delhi High Court in the case of Subodh Gupta, 2015, 54 taxman.com, 343 Delhi, in which they have given very detail regarding the where the turnover was rupees 18 crore, so which was far beyond the 44 AD limit. At that time, the limit of 44 AD was rupees 40 lakh only. Even though the assessing officer applied the rate of 8% on this turnover of rupees 18 crore. Then the ITAT held that, and Honorable High Court held that once the rate of 44 AD has been applied and section 44 AD has not been applied, then assessing officer has no authority to make any addition beyond that 8%. So any other disallowances cannot be made, because in that case, the assessing officer had made various disallowances due to cash payments or due to non-deduction of TDS and bogus expenditure. So he applied the GP rate of 60%. So so High Court held that GP rate of 60% cannot be applied in absence of comparable cases. So this is a landmark judgment for our assessees, which we can refer where, but we should not take it for granted that we should file the returns of our assessee without audit, even if their turnover is exceeding the limit of rupees 1 crore, 2 crore or 3 crore, as the case may be. So we should get, first of all, his books of accounts audited, but these cases may be pertaining to the search or survey or so, or any unintended error by the assessee. So we may take shelter only at that time only. This should not be intentionally. Otherwise, the assessing officer will not take the rate of reduced. He may, if he doesn't take any specified rate, then he can carry out the assessment on the basis of books of accounts and on the basis of available evidences. 8% and pick credit. ITIT Chennai, in the case of Sri Devi Ravi Chennai versus ITO, held that once the assessment is completed under 44 AD of the Act, then pick credit cannot be applied. So in that case, the assessee failed to include one of the bank account. But when the assessee received reassessment notice, the assessee had come out with the explanation that cash deposit shall be treated as his contract receipt, and assessee is ready to offer his income under 44 AD of the Act. So once his unaccounted income is covered under 44 AD of the Act, then again pick credit cannot be applied to this case. So this is then another landmark judgment of Madras High Court in the case of Mr. Anand Kumar versus ACIT. In that case, the assessee applied 44 AD provisions on his income from partnership firm. He has certain receipt from towards remuneration and interest from partnership firm. He applied 8% under section 44 AD on those gross receipt of remuneration and interest. So Madras High Court held that the assessee himself is not carrying out any business. So assessee cannot opt for 44 AD for his income from a partnership firm. The partnership firm is carrying on the business. Partnership firm can opt for 44 AD, but assessee cannot opt for 44 AD on his income from partnership firm. Earlier, many of the assessee were getting their books of accounts audited if they were having income more than a specified limit under 44 AD of 44 AB of the Act, or they were applying 44 AD provisions on their certain income even if they were not covered under 44 AD. So they applied it as a tax planning tool. So Madras High Court has prevented this tax planning, so this is not a tax planning. This is this may be tax evasion. So this is my last discussion of this. Then I will hand over to our session moderator for further queries from all the attendees. So this is last point which I would like to discuss here. The gross receipt in case of shares, securities, and derivatives. Any of the person who is engaged in business of shares, securities, and derivatives, futures, and option is also eligible to opt for section 44 AD of the Act. If his gross turnover is not exceeding rupees 3 crore and his cash receipt is not in excess of rupees 5%, he can opt for 44 AD. And ICAI has in its tax audit guidance note has given a detailed on this how to calculate the turnover even for the purpose of tax audit under section 44 AB clause A, how to calculate the turnover in case of shared and F&O, etc. So here they have, as we all know that in case of derivatives and futures and shares transaction, we have to include only the profit or loss amount, and we have to sum up all the plus and minus, ignoring the minus sign. And this will be the turnover for the purpose of 44 AD, as specified by the ICAI in its guidance note, because income tax has never issued any such circular or any such notification or relaxation But ICAI has come out with a very logical and very detailed in this latest guidance note, which has been published in the year 2023. The detailed system has been given how to calculate the turnover in case of derivative, future and option. So here I have given these details. So the nutshell, only profit and loss has to be calculated by ignoring the minus sign. We have to aggregate this, and this will be our aggregate turnover. If it is not exceeding 3 crore, we can go for 44 AD. If it is exceeding rupees 3 crore, then we have to go for the 44 AB clause A. In case of delivery-based transaction, the total sale value will have to be included. In that case, we cannot take only the profit. The wholesale, if it is delivery-based transaction, wholesale value will be treated as your turnover. If it is exceeding rupees 3 crore, then you will have to go for 44 AB clause A for tax audit. Otherwise, you can opt for 44 AB clause A at the rate of 6%. So, Gaurangji, this was my discussion on section 44 AD in 44 ADA, 44 AA, 44 AE of the Act, and various other some important issues which I could discuss here. However, since time is not much, and now my time has come that I am to hand over mic to our session moderator, Gaurangji. So over to you, Gaurangji.
Thank you so much, sir. It was a very good session. Let me take up a few questions which we have received. First is, we need to understand if one is opting 44 ADA and having turnover less than 50 lakhs, then is TDS applicable or not?
So if anyone is opting for section 44 ADA, then TDS provisions are not applicable. If his gross receipt is exceeding rupees 50 lakh, then TDS provisions under 194A, 194C and 194J are applicable. Even if he is opting for this 75 lakh relaxation, but he will be liable for TDS if his gross receipt is exceeding rupees 50 lakh. But there are some other provisions which are applicable irrespective of the turnover. Say, for example, if anyone is paying salary to any person, which is liable for TDS, which is in excess, if there is any tax liability on any salary which is in excess of certain specified limit, or if anyone is paying any rent of rupees 50,000 per month to any other person, then he is liable for TDS under 194I capital B, or he is liable for TDS under 192. So these provisions are applicable to every person, even if he is covered under 44 AD or 44 ADA. Say, for example, any person is having a receipt of 40 lakh, he is paying rent to his landlord of rupees 60,000 per month, because in excess of 50,000 per month, 194 IB is applicable. If he is covered under 44 ADA and opting for up to 75 lakh, if his cash receipt is not exceeding 5% in cash, then if he is paying rent more than 20,000 per month, he is covered under 194I. So this is detail.
Second question is, in case of loss, is audit required?
If there is any loss, the audit is not required, because if income is not exceeding the minimum limit liable for filing the income tax return, then tax audit is not required, but he is required to fill his profit and loss account and balance sheet.
In case actual profit is 70%, can we still show 50% and pay tax accordingly? What are the challenges we face because of this?
But one thing I would like to again share here, that in case of loss, it is not a bear. If his turnover is more than a specified limit of rupees 1 crore, or say, for example, in case of professional, it is more than a specified limit of 50 lakh, then audit will be compulsory. But if only for the purpose of presumptive taxation, if it is less than rupees 1 crore and if there is any loss, then he is not required to get his books of accounts audited. So this thing in case of loss. And now next question.
In case actual profit is 70%, can we still show 50% in tax accordingly?
Yes,
what
yes.
are the challenges with?
Yes,
What
as
are
I
the
have
challenges
already
with-
discussed, in case laws, that if profit is more than 50%, you can declare it 50%. The department is bound to assume that you have spent 50%, even if you have not actually spent 50%. But this should not be used as a tool for accumulating the capital.
and do we still have to maintain books of accounts, or can we, since we are
No, books of accounts are not required to be maintained. Only the proof of gross receipt has to be maintained.
okay. Do we have to consider cash deposit or withdrawals by partners while considering eligibility under Section 44 AD? 8%, 6%.
Yes, because for the purpose of 8%, they have told that aggregate of the cash received, amount received in cash. So even if amount is received from partners, prima facie, it will have to be included. Because if you want to say that partner and firm are the one and the same, so you may have to go for the appellate stage. So on a safer side, we should include this.
Can an architecture offering income under normal provision for past 3 years, having professional receipts below 75 lakhs in financial year 23-24 opt for 44 ADA?
Yes, in case of 44 ADA, every year he can opt in or opt out. So he can opt.
Yoga instructor, trainer, sound healing instructor, counselor. Can person with this qualification and practice can claim under Section 44 AD or ADA?
44 AD is applicable because yoga instructor is not a medical profession. It is not covered under 44 AA subsection 1. It is covered under 44 AA subsection 2. So he can opt for 44 AD.
Under the respective section, under the respective section of 44 ADA, no books of accounts are to be maintained, but 10 is required for turnover above 1 crore. How to cope up with that?
Please again repeat this query.
I guess the question is under the respective section, no books of accounts, but 10 is required if the turnover is above 1 CR.
Yes, if turnover is more than 1 crore, books of accounts are not required to be maintained if anyone is opting for Section 44 AD up to turnover of rupees 3 crore. But he is required to obtain the 10 number and deduct the TDS. So TDS provision are applicable.
Can a partner of a CA firm claim the benefit provided under Section 44 ADA for the remuneration received from the firm?
No, as I have told that Madras High Court has clear-cut denied.
Is the assessee opted under 44 ADA required to maintain books of account when the entire receipts are through the banking electronically? Whether partnership firm is allowed to claim interest and remuneration to the partners from the presumptive income?
No, partnership firm is not allowed to claim interest and remuneration. Only in case of 44A, partnership firm can claim interest and remuneration.
So 8%, 6% should be after reducing the remuneration and the interest of the partners.
Yes.
Is cash basis is mandatory or assessee can offer mercantile system?
Assessee can offer mercantile system.
But in that case, for the purpose of 44 AD, for the for 6% and 8%, for the for
cash
6%.
basis word is not there. Cash basis word is not there. Only the amount received in cash. They have referred that amount received in cash. So I think either query is not clear. So cash basis is different, mercantile is different.
So for the purpose of Section 44 AD, if we receive income through banking channels, we have to offer 6%.
Yes.
What if the case if we have sold in the current year, we have not received the amount in the same current year, and we have received the income in the next year?
So up to,
Okay.
if you have
In those
not
cases,
received the amount up to 139(1) due date, then it will be covered under 8%.
okay. Acha, due, it should be before
Up to
31st
due date.
July.
Yes, 31st
That's-
July. Yes, yes. After 31st July, it will be, you have no control, so it will be covered under 8%.
Acha. In last, if the last year person opted for 44 ADA, current year he wants to do audit under section 44 AB as his profit is less than 50%, whether they in the next year he will be able to offer presumptive taxation. The 5-year clause is only for 44 AD and not for 44 ADA.
Yes, yes.
Correct. The client is also doing option trading business. Can he offer both 44 AD and 44 ADA parallelly?
Yes. He can opt for, if he is a professional as well as he is carrying out any share trading business or future and option, then he can simultaneously opt for 44 AD and 44 ADA because the income tax portal is allowing you. However, section 44 AD specifically says, 44 AD subsection 6, that any person carrying out specified profession cannot opt for 44 AD. But since the portal is allowing you, so you can do. Otherwise, if any of the person is opting for covered under 44 ADA, he cannot opt for 44 AD. But the drafting itself is wrong because they have excluded only the 44 ADA. So for the purpose of any income which is eligible for 44 AD, he can opt for. So both are separate. 44 AD is separate and 44 ADA is separate. So there is some drafting error, but as I have discussed as per Supreme Court decision, that anyone is, however, if he is carrying out share business, it is covered under 44 AD. And portal itself is allowing. So portal is the mirror of the Income Tax Act. If it should not have been allowed, they would have prevented from the portal or utility itself.
In case of a salaried employed, can we take a benefit of 44 AD for option trading?
Yes, yes.
Yes. Is the professional fees paid to the directors, sitting fees, are covered under 44 ADA?
No, no, it is income from other source. However, TDS is deducted under 194J, but it is income from other source. It is not a 44 ADA.
If the turnover is about 2 crores and TDS is not deducted, software developers doing business in a firm, partnership firm, section 44 AD or 44 ADA will be applicable.
If the firm is comprising of the information technology experts only, then it is covered under 44 ADA. Because any of the partnership firm carrying out specified profession, then only they are covered under 44 ADA. If the software development is being done by the persons who are not the information technology expert, they are the simply other diploma holder or any other person other than information technology expert and not covered under 44 AA subsection 1, then they are not liable for 44 ADA. They can go for 44 AD or normal audit.
If a person has opted for 44 ADA, his gross receipts is 30 lakhs and has offered profit of 15 lakhs in the income tax return. But he has added 30 lakhs in his capital account. Is it correct? can a CA certify that capital account for the purpose of net worth certificate?
As I have discussed in some case laws, that if anyone has opted for presumptive income of 44 AD or 44 ADA, the assessing officer cannot make any inquiry of any of his expenditure. But it should not be used as a capital accumulation tool. CA can certify that if he is adding this 30 lakh, but at the time of assessment, the assessee may have to face some consequences. The ITAT may take other view if he is taken out of clutches of 44 ADA. If the assessing officer has taken him out of 44 ADA, the additions can be made regarding his undisclosed income.
If an individual any gross receipts from any professional, okay, if any individual's gross receipt from any professional income under section 44 ADA is shown under presumptive basis, and simultaneously in the same year he has loss from the options due to which he is liable for audit, can we conduct audit of 44?
No. If once the audit is covered under 44 AB, then his other business should also be subjected to tax audit.
So it cannot be that in one particular source of income we are opting for presumptive, and for one we are doing audit. That is not permissible. So in that case, let's say I am eligible for audit under section 44 ADA.
Yes.
And I am also doing a business using presumptive taxation. But since now I have to, I am eligible for audit, I cannot offer presumptive taxation.
Yes.
So in the next consecutive years, I'll be opted out. Mandatorily, I'll be opted out for the purpose of 44 AD, even if I don't have any income of 44 ADA.
If once you have opted opt out of the 44 AD, then in next year you will be subjected to audit. In case of 44 ADA, every year you can opt in and opt out. But in case of 44, if you are covered under 44 AD, but you have lost and you have got your books of accounts audited, then and adjusted the loss out of that 44 ADA income, then next year you will have to get books of accounts audited as per 44 AD, subsection 4 and subsection 5.
A person who is not a chartered accountant but has cleared his IPCC and have accountant technician certificate from ICI is eligible for 44 ADA.
He is not required to follow the 44 ADA because he is not a specified professional covered under 44 AA subsection 1. He is covered under 44 AA subsection 2. So he will have to go for 44 AD.
Does gross receipts for section 44 ADA includes GST?
No. Because GST is separately collected, there is some judgment also of earlier based on the service tax. They have specifically told that this service tax is separately collected and collected on behalf of the government, so it should not be included for the purpose of determining the limit or for the purpose of calculating 8% or 6%. So it should not be included.
Whether section 68 to 69C could be invoked in case an assessee opt for 44 AD or 44 ADA.
I have already discussed various case laws.
As you have explained, for calculation of 5% of aggregate receipts or capital expenditure will also be covered. But in my view, section talks about only gross receipts, that is sales and revenue receipts, and not the unsecured loan received, or similarly for the expenditure, it should not cover purchase of fixed assets.
So I think two things are mixed. Okay, nothing. I clarify. For the purpose of 10 crore, 44 AB clause A first proviso, all receipts are to be covered. Say for example, sale, amount received from various old debtors or current year's debtors, unsecured loan received in cash, amount received against sale of fixed assets. This is the aggregate amount, and aggregate of this, 5% of aggregate of this should not be in excess of 5%. So cash received on aggregate of this, in excess of 5% should not be in cash. Similarly, for these 10 crore payments, payment to creditor, payment to earlier year creditor, purchase of fixed asset, or payment to unsecured loans, if it is not of more than not of 20,000 or more. If any unsecured loan is offered less than 20,000, you can make cash payment. So all these payments for any other purpose in cash, it should not exceed 5% in cash of the aggregate of payment, including payment for purchases. Similarly, in case of receipt, including the sales. So this is different provision for 10 crore. And as regards 3 crore, 3 crore limit, there they have mentioned that aggregate of cash received should not be in excess of 5% in cash of a turnover. So only turnover, 5% of the turnover is there. But so say for example, you have received amount from debtors, from previous year's debtors, all these are the cash amount. But 5% will have to be calculated of the turnover. So I have given it in very detail in my two examples. So I will share this PDF so you can also understand this. I have very clearly mentioned there how to calculate this 5%. So 5% will be calculated of the turnover for the purpose of 3 crore. So we should not equate it with the 44AB first 44ABA first proviso. Both are different.
Is there a definition of IT professionals for section 44 ADA?
Information technology expert. There is no definition of IT professional. If any person who is covered under information technology expert, then he is 44. He is a specified professional covered under 44 AA subsection 1. So in any IT professional means who has degrees of MTech or BTech or such other degrees, he may be covered under IT professional. Like the chartered accountant who has degree from ICI, he is only the person who engaged in accountancy profession. So we will have to see that.
I am a CA not having COP or carrying any professional work. I am in the business of mutual fund distribution. My income for current year is likely to touch 1 CR. Whether I will be liable for tax audit?
It will be covered under 44 AD.
It will be covered.
If you are carrying out business, then it will be covered under 44 AD. It has nothing to do with the profession.
Sports team physician should be covered under 44 ADA.
No.
Are they considered as a medical profession?
Yes, I have already discussed that only TDS is to be deducted under 194J for the sports professional or any such umpire or any event management involved in the sports activities. But for the purpose of business income, he will be covered under 44 AD only, not 44 ADA.
Yes, sir. The question is pertaining to physicians, sports physicians. So
44 AD. So sports, if he's a doctor, then if he's a person having a specified degree of medical profession, he is a medical profession, then only he is covered under 44 ADA.
Okay.
Then he will come out of the sports.
So like ortho, in case of an ortho, and that ortho is a
if
physician.
he is covered under medical profession, then he will be covered under 44 ADA.
So degree is important.
Yeah, degree is important.
Okay. SAP financial consultant involved in ERP implementation is covered under section 44 AD or 44 ADA.
So if he is information technology expert, then he is covered under 44 ADA. Otherwise, no.
A consulting services provided on broad basis, financial, technical, to a field, tax, accounts, etc. by an individual be considered as business instead of specified profession.
Business.
So the question is, a private limited company cannot run hospital as per this presentation.
So as per this is the case law. Private limited companies are running the hospitals. Private limited can run the hospital, but they are not covered under specified profession. They are covered under business. So the limit specified under 44 AB clause A is applicable to them. Private limited cannot go for 44 AD and cannot go for 44 ADA. And private limited is carrying on business. In case of partnership firm, if doctors are carrying on any partnership firm, then doctor and partnership firm are the one and same. In case of doctor, in case of chartered accountant, 44 ADA is applicable. But in case of private limited or LLP, this 44 ADA is not applicable.
A doctor is doing a job in a private hospital and TDS is deducted under section 194J. Can he file his return under section 44 ADA?
Yes, if his TDS is being deducted under 194J, then he is providing his services in his professional capacity, not as an employee. So he will be covered under 44 ADA.
The assessee with turnover of 9 CR having no cash payments or no cash receipts can declare profit at less than 6%. Please clarify.
Yes. If his turnover is not more than 10 crore and his aggregate cash receipt and aggregate cash payment is not more than 5% in cash, then he can declare his actual profit or actual loss, whatever, by filing the simple ITR 3 in the P&L balance sheet only.
No audit is required.
No audit is required. But TDS provision will be applicable on amount in turnover in excess of rupees 1 crore.
Once a person opts for presumptive, does he need to file ITR 3 if there is no business revenue and gross in a particular year?
No, if it is 4480, then ITR 4 is applicable. But if he's having other income for which ITR 4 is not applicable, then he will have to go for ITR 3, including the presumptive income.
If an assessee is assessed under section 44 AD, the unexplained cash credits in the form of unsecured loans can be added by AOA by officer under section 69A.
Yes, if this amount is not covered under your turnover, then assessing officer is all right. He is right because he is this cash credit is limited only for the purpose of amount of the turnover. If it is more than, say for example, your turnover is 70 lakh and in your bank account the receipt are 90 lakh, so 20 lakh is towards the unsecured loan. So assessing officer has power to inquire about this 20 lakh.
Travel agent charges commission, say of rupees 100 over and above the flight ticket. Can he opt for 44 AD being a commission agent?
No, if it is covered under commission agent principal and agent relationship is there, then it will be not covered under 44 AD.
Delivery based transaction in case of share capital, in case of shares, they are considered as capital gains. Correct, no? No.
Yes.
It's a delivery. Whether in case of LTCG, STCG on sale of shares, may we treat all this transaction as business transaction?
No. Any SSC can have two different portfolio, one for the business, one for his investment. If there is investment, then it will be covered under LTCG and STCG. This will not be treated for the purpose of business. So SSC can maintain two different portfolio. If it is not for the purpose of business, LTCG is not liable for 44 AD.
The questions, few of the questions are in repetitive in nature. That's why I'm skipping those questions.
Yes.
Can we claim depreciation within 50% limit? Gross receipts are 20 lakhs, expenses are 6 lakhs. Depreciation is 1 lakh. What profit should be declared?
For the purpose of 44 ADA?
Yes.
If gross receipt is 20 lakh, then as per 44 ADA, you are required to show your profit of minimum 50%. So it is deemed to have been that all the expenses between section 30 to 38 have been deemed to have been claimed. So separate depreciation cannot be claimed. So for this, either you will have to go for the audit or you will have to maintain the books of account. Because their gross receipt is less than rupees 25 lakh in case of individual.
I guess we have covered quite many questions, and most of now the questions are getting repetitive in nature. So we would, we can end the session. Members will be sharing the presentation with you, and you can, in case you have any queries, is it okay if they can connect with you directly, speaker? Okay, so thank you so much, Rajesh sir. It was a very informative session, a very exhaustive session. I am sure members would have really benefited. It looks a very simple section that no section will be applicable, but it's quite complicated. So thank you for understanding us the complexity of this section and making us easier. Thank you so much. Thank you to all the attendees who have attended the session. Thank you so much, sir.
Thank you, everyone. Thanks to all.
Thank you.